The Bank of Japan has officially intervened in the currency market. With the yen's sharp decline posing a threat to the global economy, Japan is spending billions to defend its currency. Stick around as we delve into the massive risks of a carry trade unwind and how the debut of a new Fed chair is already shaking the foundations of the financial world. So, why is this happening right now? The US dollar index has surged to 101, its highest since May 2025. This climb is fueled by hawkish signals from the Federal Reserve, with half of the FOMC members anticipating at least one more rate hike in 2026. This widening interest rate gap is placing unprecedented pressure on the yen and other Asian currencies, leaving Japan scrambling to stop the bleeding. The market shock isn't just confined to currencies. Gold has plummeted by $146 in a mere 2 hours, a staggering 3.31% drop. This dramatic fall aligns with the debut of the new Fed chairman, Warsh, whose aggressive policy stance has caught many off guard. This has triggered a massive recalibration across all commodities and rate-sensitive assets. Additionally, in the energy sector, Iran has announced the closure of the Strait of Hormuz, citing U.S. policy failures in Lebanon. This could lead to a significant supply shock in the oil market. On social media, market participants are raising alarms. A popular post warns that if the yen continues to decline despite the BOJ's intervention, the borrowed money fueling global markets, the carry trade, could unwind violently. Traders are noting that the 10-year Japanese government bond yield is now approaching the 3% mark. There's growing concern over fiscal instability, with users cautioning that growth strategies lacking clear funding sources are contributing to rising interest rates and eroding confidence in Japanese assets. Analysts are honing in on the fiscal aspects of this crisis. There's a consensus emerging that the BOJ's intervention is merely a temporary fix if the underlying fiscal anxieties remain unaddressed. Experts warn that as long-term rates rise, servicing government debt will become a significant pressure point. With Chairman Warsh's hawkish debut, it seems the era of low rates is firmly behind us, compelling Japan to rethink its entire monetary and fiscal strategy. What does all this mean for Japanese stocks? While a weaker yen usually benefits exporters, the rapid pace of its decline is putting significant pressure on equities. The potential unwinding of global carry trades often triggers broad selling in the Nikkei 225 as liquidity tightens. Moreover, the rise in 10-year JGB yields nearing 3% is impacting valuation models for growth stocks. Investors are closely watching to see if the BOJ can create a credible floor to stabilize the currency and support domestic markets. The global ramifications of these developments are immediate. Iran's closure of the Strait of Hormuz poses a direct geopolitical threat that could spike oil prices, adding an inflationary layer to an already hawkish Fed environment. Emerging markets are also feeling the strain as the dollar approaches the 101 mark. With gold falling sharply, investors are witnessing a significant recalibration of what constitutes safe haven assets in a world where both the Fed and BOJ are taking aggressive stances. For individual investors, this environment demands heightened risk management. Keep a close eye on the signals from the October FOMC meeting. Another rate hike could push the dollar even higher. Monitor the critical 3% yield on the 10-year JGB. If it breaks significantly, the pressure on Japan's fiscal position could trigger further yen volatility. It's wise to avoid over-leveraged positions that depend on low-interest yen borrowing, as the carry trade unwind is no longer a theoretical risk. Our AI analysis outlines 3 potential scenarios. In the base scenario, the BOJ's intervention establishes a temporary floor near current levels, but volatility remains as markets test the 3% JGB yield. The bull scenario envisions a swift easing of geopolitical tensions in the Strait of Hormuz and a less hawkish Fed, allowing the yen to recover to 145. Conversely, the bear scenario predicts JGB yields spiking to 3.5%, the BOJ failing to stop the yen's decline, and a violent carry trade unwind sending global equities down by 10% or more within weeks. In conclusion, the BOJ has intervened with billions, the dollar is at a multi-year high of 101, and gold is in freefall. Watch the 3% JGB yield and the situation in the Strait of Hormuz as key triggers moving forward. If you found this deep dive into the yen crisis insightful, please like this video and subscribe to Tokyo Macro for the latest insider perspectives on Japan's economy. What do you think? Will the intervention succeed? Share your thoughts in the comments below.